Good morning, everyone. Thank you for joining us this morning. Absa Premier Banking welcomes you to this session where we shall be discussing the macroeconomic and investment market report. I'm really looking forward to this session. I hope you are. And we hope that you shall find the session quite helpful to you, useful, and insightful. And without much ado, I want to introduce the MC for the day, Hannah, to take it up from here. And welcome. Thank you.
Thank you to our Premier clients for joining us this morning. Thank you also to Absa Premier for having us today. We are going to go through the macroeconomic and investment market report review, and we believe that this report will be highly beneficial to you. To take us through this in detail will be Anthony Withiga, who is our Chief Executive Officer for Absa Asset Management Limited with over 20 years experience in the investment space. We will also have John Kihara, who's the Chief Investment Officer for Absa Asset Management Limited, who has over 14 years experience, who will take us through this also. Thank you. Over to you, Anthony.
Thank you, Hannah, and good morning, our Premier customers. It's indeed a great morning to share some moments with yourselves to discuss matters of economic and investment markets. We'll take this opportunity in the next 30 to 45 minutes to explain some of the things which have happened in the economic space and investment markets, just to make it simpler for you as you make your financial decisions from a day-to-day perspective. Once again, welcome, and I'll pass it to John, who is also joining us this morning.
Dear Premier customers, indeed, good morning. We're very excited this morning to share with you some insights on the macroeconomic and investment markets updates. I know customers, given what has happened in the last, call it 18 months, we have been through a COVID situation. And I think it's important just to recap, just in terms of what has been happening within the investment markets. And of course, in terms of the insights going forward, what it is that we expect. So great to have all of you on the call, and we really appreciate it. Thank you.
So thank you, John. So I'll go first. I'll take us through the first session of the presentation. Our session for this morning, our clients, is broken into three, as you can see from your screens. I'll take the first part, which talks about the macroeconomic review, specifically for the third quarter of 2021. My colleague John will take us through the investment markets review for Q3 2021, and I'll come back and give a wrap-up commentary about the investment strategy, which is underpinned by our first two sessions. So if you indulge me, I'll straight jump on it, and I will discuss about the key four macroeconomic indicators of our country which shape the day-to-day business. Our Premier customers, we understand and believe that these matters are important, and they're important because they influence the direction of investment and our financial needs, and also our investments. We also appreciate that these matters are not simple from a day-to-day perspective. I know all of us, including us who do this on a daily basis, sometimes are challenged by understanding this even from watching business news on television. So we'll try and make it very simple for you, and kindly indulge me as I go ahead with the first macro indicator, which is inflation. I think if you've been around in the country for the last 6 months, you must have faced some form of inflation from your day-to-day activities, where the biggest indicator of inflation is the price of goods and commodities which we buy on a day-to-day basis. So as you can see on the screen, we are saying that the overall inflation from a similar period last year to now edged up to 6.6% compared to a previous period of 6%. What that means is just means the price of buying a service or good edged up slightly. And that is a reality we have come to understand and have to live with it. Most of the inflation, unfortunately, is brought about by the imported effects of a key item in the energy environment, which is oil. And that, in the period we are discussing, went up from, had an upside in terms of price of oil per barrel, 4.5% increment to $78 per barrel. And you felt it in the local pump prices, and that has affected many other products and services because energy, specifically oil, specifically fuel or petrol, makes things go round and enables our movement, both for goods and services. Locally, the government treasury has utilized the petroleum levy to cushion in Kenyans and by general consumers from the heavier impact of inflation. We also wish to note that the inflation we've also witnessed has been demand-driven. And what does that mean? With the opening of the economy in Q3, there has been a propensity to spend more. There's been a propensity to spend in services and products which we had slightly foregone in previous quarters of the year because of the restrictions of COVID. And the upsurge in demand or utilization or consumption of those products and services has brought about a slightly spike in inflation. From an outlook perspective, it's very clear that inflation will continue edging up, though slightly. And the Central Bank of Kenya has a target for this to rise up to around 7.5% for the full year, mainly driven by, I would say, oil or energy, specifically fuel, and secondly, food prices. You must all be aware that currently we're in the middle of the short rain season, and there's an indication that the short rains we are receiving now won't be as successful as expected. And for that reason, there might be shortages, and those shortages in short-term agricultural products like vegetables might filter through in the inflation numbers. I'll jump to the second item, which is currency. And by currency, we mean the exchange rate. How has our shilling, the Kenyan shilling, behaved against other international currencies? And this is a reality because as our customers, you interact with other currencies other than the Kenyan shilling. You interact with the US dollar, you interact with the euro or the British pound, or even the Chinese renminbi. And for that reason, there's a need for us to appreciate that this is a fact of life, and we need to monitor. If you look at the bar graphs we've given you, which we've tried to simplify, the bars which are upside down or below the baseline show you that the Kenyan shilling has slightly weakened against a specific currency. For example, against the US dollar, under the period we are discussing, the Kenyan shilling weakened around 1.2% against the US dollar, 0.4% against the British pound, and gained 4% against the euro, and 2.5% against South African rand, and again weakened against the two common East African currencies of Uganda and Tanzania. In your slide there, UGX means Ugandan shillings, and of course strengthened against the Rwandese franc. From an outlook perspective, we expect the Kenyan shilling to be under pressure, not too much pressure, but pressure to weaken, and there are two key factors which are pushing that. One is demand related, as we try now to import more as the economy opens up, and secondly, there's a huge portion of the country's debt, which is denominated in foreign currency, and the demand of foreign currency to make those repayments towards first quarter of next year might slightly put some pressure on the currency All in all, we strongly appreciate the efforts of the Central Bank of Kenya in keeping the shilling stable, which they have done for quite a long time now. I'll jump to the third macroeconomic item or parameter, which we want to discuss with you this morning. I mean, our premier customers, this chart we are showing you is about short-term interest rates. So these are not interest rates of term deposits, the ones we discuss with you on a continuous basis with our relationship teams. These are not lending rates. These are not the rates we discuss with yourselves when we discuss about your credit facilities. These are rates, indicative rates of a direction of interest rates in the country. And the better choice is the three types of treasury bill rates where every other credit product is priced against. So we've picked the shorter 91 treasury bill, the 182 6-month treasury bill, and the 1 year 365-day treasury bill, just to show you how interest rates have been spanning out for the period we are covering. If you can see too in the chart, and kindly indulge us as financial and economic experts, charts is almost our life. And we also kindly request you also put some time to look at these charts. They're simple to understand and simple to follow. And most of you are investors in treasury bills, so you understand how these rates move. If you look at between the shorter 3 months, 6 months, and 12 months rates, the difference between the rates has been actually almost uniform since the middle of the year up to the end of the third quarter, which was 30th of September. What does that tell you? It shows you there's been a bit of stability in terms of the difference between the rates. But one thing you realize from the chart again, the three lines, the orange, the red at the bottom, and the black curve at the top, they are all edging up slightly. That tells you there is a bit of pressure in an upward movement of indicative interest rates as shown by the treasury bill yields we are showing you. So what does that tell you? That tells you two things. One, they are reacting from a rising inflation, trying to compensate investors for erosion of value, and secondly, and not to a bigger extent, some demand in this type of securities or products, which are treasury bills. From an outlook perspective, you're saying we expect interest rates as measured by treasury bill rates to edge up marginally as we go towards the end of the year. And that edging up will be heavily influenced by the inflationary pressure we are seeing. But for long-term rates, which we can say from 1 year up to 25 years, as measured by treasury bonds yields, will still remain a bit stable. And we know you, as our premium customers, you invest heavily in treasury bonds, and you can see from monthly auctions of treasury bonds how these yields or rates are being influenced by the shorter rates, which we've shown you. Next, and the last macroeconomic indicator I'd like to speak to you, our customers this morning, is GDP. You know, GDP is extremely topical, gross domestic product, and it's simply a measure of the value of goods and services produced by any country in any specific year. We've given you a chart there just to show you how we've performed as a country in the last 5 years, since 2015 up to 2019. Not a bumpy ride, but a mixed bag, from 6.5 as the highest ever achieved in the last 5 years in 2018 before COVID set in, and then the rest are all edging up between 4.5 to the 6.5. One good indicator you can see in 2019, though it was a COVID year, though it was a pre-COVID year before last year, the economy was growing pretty well. From relative numbers in the region, any economy growing between 5 and 8% is an acceptable and admirable growth rate, given the size of the economy, relative to smaller economies. Smaller economies might grow faster because they're coming from a low base. Now, when you come to 2020, for lack of a better word, we were actually on a on a recession. A recession happens when the growth rate of a country becomes negative. And we all agree last year, after March, almost everything for the next 6 months came to a standstill. All the services and goods produced in 3 key sectors, for example, education, hospitality, and certain services, they came to a halt, and transportation. Now, that contributed heavily to what we saw last year. 2020 had a huge lockdown of movement and restrictions of accessing public spaces and distribution of key products and services, and that filtered in the economic numbers, and that's where you are seeing that's happening. From an outlook perspective, we are saying that there is strong green shoots in 2021. That's where we sit today. The GDP, though coming from a low base, is likely to do 4 to 5.5%, which is a massive growth coming from a recessionary environment last year. The key risk factor to this 4 to 5% economic growth is still some level of restriction related to COVID. Again, low vaccination rates of COVID, though it's really improved. We understand close to 6% of the Kenyan population is already vaccinated, and that has enabled movement of people across the country and to do business. We know curfews have been removed, entertainment and other service industry related economic activities have fully been opened. The containment measures, though eased up, also people have learnt a new way to restrict their interaction. And anytime people restrict their movement, there is a deferred economic activity, and that should filter in through the numbers. Lastly, something which might again dampen the 4 to 5% GDP growth rate we are focusing for 2021 is, unfortunately, the short rain season, which is we are underway, seems to be failing. Across the country, there are pockets of drought in most parts of the country, and the rain is raining. The short rains are raining sparingly and not as expected, and that means there might be a shortage of basic food products in Q1 of next year and towards the end of the year. But again, we are going now to a festive season, which is December. Some economic activity might be seen as people try to spend and put more money in economic activity, specifically the small and medium-sized businesses, which depend on people's increased activity. So, Premier customers, I'll stop there from discussing yourselves about the macroeconomic environment, and now I'll pass it to my colleague, John Kihara, who is our Chief Investment Officer at Absa Asset Management Limited, which will take us through now what those numbers or that discussion of economic indicators mean to investment markets. Welcome, John.
Thank you, Anthony. That has been a very good sort of like a background just in terms of the macro space. Because our dear Premier clients, the macro space is very important when you look at how the investment markets react. When we talk about economic growth, like what Anthony has spoken about, of anywhere in the region of 4 to 5%, then obviously that does have a very big impact in terms of how the various investment markets move. So I'm going to take the next few minutes to talk about some key investment markets, 4 of them. I'm going to talk about the fixed income market. I'm going to talk about the local stock exchange. I'm also going to talk about the offshore markets. And finally, I'll talk about the property market. So to start off, we'll discuss the fixed income market. So by fixed income market, obviously we are referring to investments which when an investor puts in their money, whether it's in government securities or in corporates, there's a level of assurance in terms of when the interest payments are going to be paid and also when the return of capital is going to happen. So if I started with what's happening within the local space, within the government securities space, and I know most of the clients who are on the call already have some investment within the government securities. I think the key thing that you're seeing here is that there has been a lot of interest within the government securities space. I think it's understandable. We have come from a very challenged environment. So we have seen a lot of investors postpone their investment activities in the broader economy and sort of like run to safety. And of course, the government securities have offered that kind of security, given the environment that you have been operating in. So within the quarter, we saw a lot of interest for government securities, understandably, as I said. And we have seen central bank come into the market to raise money on behalf of Treasury. So within the course of the quarter, and indeed across the year, we have seen quite some good subscription come through for government securities that have been issued. And as at the end of the quarter, we saw, for example, if you look at what the central bank was looking to pick from the market, we saw quite some heavy oversubscription for government securities that were issued on a monthly basis. I think overall the key thing to realize is that, when the national budget is read, there's always that line in terms of what the actual borrowings are going to happen within the course of the fiscal year. And I think the key thing to note is that for this fiscal year, we're looking to borrow, or government is looking to borrow in excess of 650 billion shillings, which within the first quarter of the year, they had already borrowed very close to about 270 billion shillings, meaning that, from a borrowing perspective, the central bank has done a fairly good job in terms of being able to attract the money that you all need to go into the roads, to go and sort out many other things. I think overall what you're seeing is that, looking at the interest rate structure, which is the chart that you see there. So that chart there simply is what you see, obviously, is the different tenors for the government securities, all the way from 3 months to 25 years. And then, of course, on the y-axis, you can see, sort of like the interest rates in percentage. So I think the key thing to note there is that if you were to look at where the interest rates have been for the better part of this year, a lot of stability, which is good, because as an investor, you also want to be well compensated without a lot of volatility. And I think if you were to look at, for example, an investor who is lending money to government for 10 years, they're currently being paid in excess of 11.2%, which is a decent return. And of course, as you elongate that to 25 years, investors are getting in excess of 13.2%. I think overall also what you're saying is that, we're also seeing corporates come back into the public markets to raise funds, which is very encouraging. We have had about 3 to 4 years when corporates were not coming to the public markets. So it's quite exciting to see some corporates come into the market and raise money from the investors. So there are two key ones that we know there. Of course, there's a student accommodation company called Aecon, which was able to raise above 2 billion shillings. And of course, East African Breweries Limited, which a few weeks ago was able to raise in excess of 36 billion shillings, which Absa Bank is proud to have assisted in terms of arranging for that. I think in terms of the outlook going forward, the local borrowing program seems to be sticking up quite well, as I said. It's also encouraging to see that from a collection perspective, that is the Kenya Revenues Authority, the collections have also been good. In fact, I think for a very long time, we are not seeing them being able to hit their targets, but now it's encouraging that they're now able to surpass that. And now why that is important is because if we had any of those revenue shortfall, then obviously what that means is that the government would have to have come into the public markets and raise the target for borrowing from the domestic market. So that is unlikely to happen. So we think that going forward, of course, the returns into this space are likely to remain quite strong. But of course, as we get into the remaining part of the fiscal year, we'll get to see how that envelops. But I think the bottom line here is that, the returns in this space are quite attractive. Another market, obviously, that we monitor quite closely is the Eurobonds market. And basically, Eurobonds market is basically where a government issues debt in another currency other than their functional currency. So in this case, for example, in Kenya, we have been able to go into the international markets, and we have been able to raise foreign debt in form of hard currency, in form of dollars. Now, the important thing about this is that also helps us in terms of sorting out our currency, because then that means that is a foreign exchange that you're able to get. So what that chart that you see in front of you shows is that our yields for the euro bonds that we have issued in the international markets, we have seen a lot of stability there, which is good, because if you compare that with other African markets, you can see they are fairly high and taking an upward trajectory within the course of the year. And basically what that means is that investors are factoring in that those markets may have more risk than what we see within the Kenyan market. So I think the long and short of this is that Kenya is looking to issue more foreign denominated bonds. Already this year we have been able to successfully issue 1 euro bond for 1 billion shillings, which we saw a lot of subscription, oversubscribed by over 5 times, which is good. And we think that as the Treasury looks to issue another one within this fiscal year, we are likely to see quite some good high appetite coming in from the international investors. I think we just wanted to highlight, of course, as a country, from a rating perspective, the debt issue is a topical issue. So, of course, given the wider ramification that we are seeing from a high debt outlook position, that continues to affect our rating. But even that notwithstanding, we are seeing quite some good subscription, and we think that even the next Eurobond is likely to be quite successful. We'll go to the next market that we closely follow through. That is the local stock exchange or equities. I think the key thing we note here is that, as expected, if you look at that chart, the stock exchange is driven by many factors. Of course, one of the key factors is investor sentiments, and of course, underlying corporate earnings. So for 2021, specifically, we have seen quite some good performance come through. For the quarter sitting at about 3%, and of course on a year-to-date by a measure of an index called the Nairobi All-Share Index, that is up about 17%, which is quite encouraging. And of course the key reason being that we have seen quite a lot of foreign investor support come into our market, and of course the underlying companies that are listed, the bulk of them have actually done quite well. And I think if you have to look at some of the key sectors that are represented on the listed space, for example, Safaricom, which is the biggest company by market capitalization, we have seen very strong earnings come through. In fact, in the last 2 weeks, we have seen them release their half-year earnings growth of in the north of 12%. Within the banking sector, again, a very big sector that is represented within the stock exchange. Again, we have seen, in most of the cases, very strong growth. Mainly as a result of most of the businesses now being able to service their loans, leading to lower provisionings for bad debt. I think going forward from an outlook perspective, we think that the corporate earnings are likely to keep improving on the back of the kind of recovery that you are seeing within the broader market. It's very encouraging to see the earnings numbers come out quite well, and that is obviously positively impacting just in terms of the investors' sentiments going forward. So for investors, of course, we see a good market, especially for the medium to the long-term investors looking to get into the market. We'll go now to another market. This is the private market. And basically, sorry, before we get to the private market, let's go to the offshore markets. And basically, offshore markets is the broader markets that are outside of the East African stock exchanges. I think the key message here has been in line with the global recovery that we are seeing. A lot of the economies obviously have done very well. If you look at the developed markets and emerging markets, vaccine rollout has been fairly successful, just like we have locally. And in most of these economies, we have seen, almost, 50+% of the adult population being vaccinated. So as a result of that, we have seen a lot of reopening for most of these economies, which has had a very positive impact. And I think secondly, we have also seen a lot of support for a lot of these central banks trying to support their financial markets through stimulus packages and also through keeping low interest rates. So you can see from a performance perspective, very strong performance. If you look at the US market, on a year to September basis, sitting at about 15%. If you look at the key European markets, again, very, very, very strong. And I think from an outlook perspective, in as much as inflation now is becoming a big headache, just like we have here in Kenya for most of the economies, we still think that the underlying markets and companies specifically seems to be also doing very well, which is quite positive for investors. And also secondly, and I think which was also very important, in most of these economies, interest rates are quite low. In some of them, we have seen interest rates below 1%. So you can imagine with investors being faced with such low interest rates, then of course there's a lot of shift towards the risky assets. And that obviously tends to favor the equities market as what we are seeing here. So the outlook is quite positive. We'll now go to the private markets. And private markets for us is important because, again, as we talk about the listed public markets, of course, there are many segments of the economies that are not represented, especially if you look at the Kenyan perspective. There are very few sectors or companies sitting within, for example, manufacturing sector, within the tech, within education. So the private markets, which are accessed through either buying direct stakes into companies or going through private equity funds, which are basically funds that tend to pull money from investors and then they're able to put into the business, re-engineer the business and obviously be able to sell the business at some point and be able to give back the returns to the investors. We have seen quite a lot of activities, even within the COVID situation. So what you see there is just some of the funds that are operating within the wider East Africa and also within the African space. A lot of these funds, obviously, pick money from especially development funds. They also pick money from family offices and, of course, from investors like yourselves. So we have seen a lot of activities come through there, investing in a lot of these sectors that may not be represented in the public markets. And, some of them have done quite well over the years. So from an outlook perspective, we still think there's going to be a lot of these private transactions. I think every day we get to see many of these transactions. And of course now with what has happened for most of these quality businesses that may want a bit of cash flow or money into the businesses to take them through the post-COVID environment, we are likely to see a lot of transaction obviously come through this particular environment. And finally, we'll go through a market that I know most of our esteemed premier clients, you are fairly well invested in, and that is the real estate or the property market. So we are breaking it down into the various subsectors. We'll start with the office subsector. One of the sectors that have come under pressure, of course, with all this working from home, especially during this COVID environment, we have also seen quite a fairly high oversupply in some of the nodes. But we think going forward, of course, as return to offices starts to gain traction, this is a sector that probably might start to see quite some recovery. But I think what COVID has done is that it has introduced some form of remote working. And therefore, we think that, this is a sector that obviously will take time to be able to fully recover. The second sector is retail. By retail, we mean obviously your shopping malls and all these other places. And what we have seen from some of the recent reports is that there has been a lot of at least return to those kind of recreational facilities with obviously what's happening within the wider COVID situation. But obviously, if you look at some of the shopping malls, for example, obviously some of them are struggling, and especially where the malls are very close to each other and seem to be cannibalizing from a traffic perspective. And also, we have seen some of the key retailers exit the market, but positively, we're also seeing a lot of expansion by some of the other retailers coming to take some of the space. But I think generally, going forward, it's a sector that will obviously mean that for those shopping malls that might be too close to each other, they might be challenged. But of course, in the wider scheme, as people become more comfortable to spend more time in these recreational facilities, we're likely to see some of the malls that have really come under pressure in the last 18 months come to a bit of life. Within the hospitality, this is your hotels space. I think that has borne the brunt of COVID situation, but we're starting to see some bit of recovery. I think there's a bit more confidence now. We're starting to see more of conferences being held in some of these positions like, like Naivasha, like Mombasa. And I think that will help just in terms of, awakening this particular sector. And also positively, we are starting to see major airlines that especially are direct flights to some of these destinations like Mombasa from Europe, which is our key tourism destination or market. From a residential perspective, again, this is also a sector in line with what has been happening within the COVID situation. We saw some of the sectors, especially the high-end, get affected as purchasing power came under pressure, and obviously tenants went to other cheaper, more affordable satellite areas. And of course, going forward, the key risk we see, of course, with this is that, for the high-end market, I think there's quite some oversupply there. But for the low to the mid market, there's quite some housing deficit that we see, which we estimate to be about 2 million units, and increasing every year by about 150,000 units. So there's a lot that's happening within the affordable housing space, obviously driven by government also. From an industrial perspective, again, by this we mean logistical centers that are coming up. There's a lot of activity there. Of course, one of the things about COVID is that it has encouraged all of us to get into e-commerce. So we are starting to see a lot of logistic units coming in, especially with some of these key nodes. I think if you go to Ruiru, you go to Limuru, there's a lot that's happening there just in terms of being able to solve the problem of logistics. Finally, about the land banks, again, there's a lot of infrastructure activities that is going across the country, obviously meaning that there's a bit of supply that's coming in. And of course, with the kind of urbanization we are seeing, population growth, we still think that this will continue to grow, albeit at a lower pace than what we have seen in the past. So I think from an outlook perspective, quite positive, but of course, the industrial and the low-end housing remains some of the areas that we think that we'll be able to deliver above average returns. So I'll pause there and take it back to Anthony to conclude with the overall strategy. Thank you.
Thank you, John. I think John has really set the scene for us to discuss investment strategy after explaining to us how the investment markets have performed in the last quarter. So we already understand we're in the deep of the fourth quarter of 2021, but it's not too late to talk about what can be done investment-wise within this quarter before the end of the year. So I'll just take us through what we consider investable or what we consider appropriate investment actions in the different asset classes and investment markets John has discussed. So, for example, in the fixed income space where John has explained to us, this is where you invest to earn interest as a return. For example, when you place money in a term deposit, you buy treasury bills, you buy treasury bonds, you get access to euro bonds, or you buy a corporate bond. For example, the recent EABL corporate bond or MTN note. Now, that is the fixed income market when you're earning an interest as a form of a return. Now, from a strategy perspective, if you remember when we spoke earlier about the direction of interest rates, we said there seem to be a bit of volatility and a slight edging up in the short end. And the short end is interest tenors of between 0 months up to 12 months. But in the long end, which is, if you allow us 1 year and above, as demonstrated by the length of the government of Kenya treasury bond issuances of up to 25 years, there's a bit of stability. And for that reason, it is highly recommended for you or for investors to consider slightly longer dated treasury bonds or any securities paying interest, especially government securities, because that's the space you get a higher coupon rate or a higher rate of interest paid, as you all know, on a 6 months basis. And again, there's less volatility. That means the change of value of your investment is marginal. On the corporate bond space, you always need to remember that when you buy a corporate bond, you're actually lending to that company. So the investors who bought, for example, the East African Breweries Limited, EABL corporate bond, you actually lent money to EABL. So there are normally three key considerations in those investments. One, from a strategy perspective, are you comfortable with the name or with the entity? And by comfortable means it's a discussion of credit quality. Do you believe they will return your principal on maturity of that bond? And if you do, you are able to invest in that bond because you are lending them money. And of course, we all know EABL are beyond recourse. They cannot fail to return investors' money. So that's normally the key consideration. And currently in this a bit tighter economic environment, we ask and advise our clients, especially our premium customers, when you lend money to a corporate entity other than a bank, really think about the credit quality of that institution. Secondly, of course, is are you getting a proper compensation from a return perspective as measured by the rate they are paying you and for the period or the tenor which they will return your principal back. So that's the fixed income market. It's not, we normally say it's simple, is a tenor, rate or yield and credit quality discussion. And that's why John, when he discussed about the fixed income market, he said there's been over concentration of buyers to treasury bonds or government securities. And why? For two main reasons. Why? Actually, three main reasons. One, the credit quality is at the top as I can get. Government securities are assumed to be risk-free. Number two, the rates or the yields, as we call them, have been averagely good. And then thirdly, the tenors have been varied. So you can be long, short, etc. The equities market or the stock exchange. I mean, this is where there's a bit of uncertainty normally under any circumstances. As our customers, I'm sure most of you have, through your lifetime, even currently, been buying and selling of shares at the stock exchange. And what it's important to always remember is that this is the slightly riskier investment market than the fixed income market. That means there's a likely of erosion in value for many reasons. And when you're investing there, you're looking for two things. You're looking for appreciation in value, and secondly, you're looking for a possibility of being paid a dividend. Always remember, companies in Kenya are not mandated by law to pay dividends. They pay dividends willingly when they wish to do so. So dividend income is not certain income, though it's always available, because these companies have to pay dividends to entice and compensate investors. And then there's also an expectation the share price will reflect the performance of that company given its financial performance. From a strategy perspective, you're saying when you look at economic activity and performance of companies listed at the Nairobi Securities Exchange, there are one or two sectors which are leading the way in recovery. Of course, telecom, by no argument. We're the largest listed telecom company is Safaricom. They've actually done better during COVID because they have enabled us to communicate more and to transact more. So they've enjoyed the season, and that is reflected in financials or their financial performance, and there's an expectation that should be reflected in their share price and their ability to pay a dividend. But also the banking sector has bounced back strongly. So when you're looking at stocks, pay attention to the stocks of the listed banks. Offshore investments, specifically offshore equities. As John covered the offshore markets, specifically the three large offshore markets of course, in Europe, Asia, and the Americas, he's hinted that there's been a bit of rally in terms of value of shares or stocks in those markets because recovery came there faster. If you remember, they had faster mechanism to deal with COVID than ourselves in the developing world. They have higher vaccination rates. They open the economies earlier, and investment markets always rally before or move faster before economic recovery, and that's why the offshore markets internationally have actually performed better than local markets from an equities perspective or shares perspective. And how do you invest in offshore markets? Mainly, you have to invest in a mutual fund which tracks the countries or the companies you are trying to invest. And though the risk is slightly heightened, we are seeing pockets of opportunity as a form of diversification from the local equities market. John talked about the private side of the stock market, which we call it private equity. Unfortunately, the private equity market is not to a larger extent available to individuals because of two things. One, it's sophisticated. We must admit, even to us as investment professionals, it's sophisticated. It requires an extra effort to digest and dissect the investment opportunities and the numbers. And secondly, it requires larger tickets to invest. By larger tickets, I mean large amounts of money. And of course, thirdly, if I may add, it is a very quiet market. You don't know what they are doing. That's why it's called the private equity market. But there's a chance some of you, our customers, from where you work, and you belong in pension schemes of your respective organizations, your pension funds might actually be investing in private equity because they are advised by fund managers about these matters. For example, ABSA Asset Management Limited is also a fund manager of pension funds. And we advise customers to invest in some of these opportunities. From a strategy perspective, we are saying we favor private equity opportunities where the providers of those opportunities, which come in form of private equity funds, have a demonstrated track record of value creation in very unique sectors, and secondly, successful exits. Because people invest in private equity to build value and sell the business and get the money. So those are the criteria we look at. So anytime as our premier customer, you find yourself in a private equity discussion, just ask the people offering you the opportunity two things. What has been your track record in managing those companies? And secondly, have you ever exited or sold those companies profitably and returned money to investors with good returns? Then lastly is property. You know, for a long time, it was impossible to give a slightly gloomy picture of the property market because it enjoyed a good run or rally up to mid 2000s, especially up to just before 2015, and then it has been a bit flat and sometimes coming off, and then in the current COVID environment of the last 2 years, certain pockets of the property market has been hit hard. Specifically, John has spoken about the subsectors in the property space. We all know commercial property, but John has broken it down to commercial office. He's spoken about retail, which means shopping malls. And it's clear that as a landlord or investor in office space, you've seen some discomfort because of less take-up of office space or even return of office space. And that must have dampened returns. From a strategy perspective, we find there's more investment opportunities and attractiveness in the warehousing space of the property market. And this has been moved by two things. One, improved transport network and logistics. So storage is required as goods move across the country. And then secondly, there is a growing market of online shopping where you own a warehouse and you distribute the goods digitally. And I mean, our customers, what's a warehouse? We normally say it's 4 walls and a roof, low cost of putting it up. And for that reason, they offer low entry in terms of construction cost and high margins in terms of rental income. All the bypasses being built in major towns across the country, for example, specifically Nairobi, there are already warehousing opportunities around, and we always advise investors to be on the lookout for such. We are glad the hospitality space, for example, as represented by the hotel industry, is starting to show some green shoots of coming back. Office and meeting conferencing is coming back. We expect this Christmas season to have higher occupancy rates across the country than last year, and that will give some impetus for that part of and so we strongly favor that. But the key new emerging investment node within the property space is affordable housing. I mean, there's extreme shortage of housing, especially with the prices below 5 million shillings. And there are numerous players and opportunities to provide housing between 2.5 million and 5 million shillings. And banks are willing to finance both the developments and the off-takers through issuance of mortgages, for example, like us in ABSA. So there's a huge opportunity there in affordable housing, and government has offered a lot of incentives towards that. So in a nutshell, our premier customers, that's our investment strategy. We see it in Q4 2021. I know you've really taken time to listen to us. I hope you've enjoyed it, whether you're on the road traveling, in your office, or just in your house having a cup of tea. We appreciate the opportunity, and we hope that this information will improve and enhance and add value to our financial decisions as we edge towards the end of the year. Thank you, and I'll pass it back to our MC of the day, who is Hannah. So Hannah, please take it away from there.
Okay. Thank you, Anthony. Thank you, John, for such an insightful overview on our macroeconomic and investment market report. I believe it has been insightful. I believe it has been helpful, and of course it has been detailed, and we know that it will definitely come in to help when it comes to the investment decisions for our clients. There are a couple of questions and comments that have come through, and we'll go through them. Thank you, Davis Odieno. He says, very insightful. Will be great if you can share the slides via email after the session. We are glad to inform you that we will share this with you on email. And you'll have also a recording of the session on YouTube available after this session if you want to revisit it. Thank you, David. There's also a question from Matilda, and this goes to you, John. What are the predictions on government borrowing as we head to an election year in 2022? Should we expect more long-term local bonds? Thank you, Matilda, for that question. Over to you, John.
Thank you, Matilda. Very good question. I think it's a very good question, given the fact that obviously when you get into an election cycle, there's always the feeling that the government of the day that's obviously trying to finish the term will obviously want to finish up on a lot of the projects that have been in the pipeline. Now, from an official position, of course, the local or domestic borrowing program for this fiscal year is at 650 billion shillings. As we mentioned so far, the government has been able, through Central Bank of Kenya, obviously has been able to issue, or rather be able to pick from the market about 41% of that particular amount, which is good because if you think about it, we're only into the third or fourth month of this fiscal year. And of course, at 41%, then what that means then is that there's quite some good traction. To your point about issuance of long-term debt, we think that it's a program that obviously Central Bank is running, where it's trying to shift the short-term debt into the long-term local domestic borrowing, where we have seen them reduce in terms of the issuance of the short-term instruments. Short-term instrument being the investment in treasury bills and also bonds that are below 5 years. We think that will continue, and that is why we think that in the remaining part of the fiscal year, we are likely to see more issuance of medium to long-term bonds. Those are bonds that are between 10 years all the way to 25 years, and we have seen a lot of interest actually from the investors for those type of tenors for bonds. I think finally on your question, in terms of our outlook going forward, as we said, our key concern, of course, was on the fiscal side and the revenue side, because again, if the numbers are not coming through, especially the ones that are collected from a tax perspective, then what that would mean is that the government would have to come in and plug that in through domestic borrowing. But I think, as we said, what you have seen is that the collection side has been quite strong. Economy seems to be picking up, meaning that there's a chance that the tax collection are likely to continue to be quite strong, which is encouraging. And therefore, we think that that will help just in terms of stabilizing interest rates. But I think overall, what you're saying is that there is good opportunities for investors in the coming remaining part of the fiscal year to be able to allocate funds into the upcoming medium to long-term bonds, which we think we still continue to have attractive yields of anywhere between 8% if you look at the very short end to as high as 13-14% for the more longer-term government securities. So I hope, Matilda, we have done justice to your question. Thank you very much.
Okay, thank you, John, for that detailed outlook on the government borrowing. Thank you, Matilda, for that question. There's also another question coming in from Samuel. Thank you for your engagement. He's asking, what is the outlook on the money markets funds we have in the country and the equity markets? This is a question to Anthony.
Yeah, thank you. Thank you for that question. Of course, anytime we mention the money market space, as the customer is asking, it is investments which have got less than a 12 months in terms of the individual securities. Money market defines investments in a pot in terms of term deposit or bank deposits, treasury bills, and any other short-term security which matures less than 4 months. When they're put together in a pot, they become a money market fund. And I mean, you are right. There's a huge growth in the money market space products being offered across the country by many players. And as ABSA, that's an area which we have a huge focus on. And I need to assure you that we will come to you in an exciting Kenyan shillings and US dollar opportunity for you to invest in the money market space. And why has there been too much interest in that in money markets? It's because for one reason, during time of uncertainty, there is bias to short-term investments, and secondly, cash is king. I mean, as John had mentioned earlier, investors and individuals and institutions have postponed long-term investments to hold lots of cash in a wait-and-see scenario to see where COVID takes us. And then secondly, there's been a higher propensity to save because people have seen the hardships experienced last year and this year in terms of job losses, collapse of businesses, and livelihoods have become harder for families. So money markets funds offer a good opportunity to save money because they are easy to access. The returns are pretty good, and thirdly, when the uncertainty fizzles out, you can access the money very fast and go to your long-term projects. On the equities side, we've gone through a strong learning curve as Kenyans in investing in the stock market or in equities. If some of you remember our premier customers, in early 2000 and mid 2000, we used to queue to buy shares or stocks through IPOs. Of course, those opportunities have not been much in the recent past, but we rarely do that. And we are doing this across East Africa. For example, there's an IPO of MTN, the telecom company in Uganda, but there is no buzz about it locally, even in Uganda, although the IPO will do well. That tells you that the risk aversion has really crept into individual investors. There's more search for less volatile, less risky investments, and hence the dalliance or increase in subscription to money market funds. That said, as we've discussed in our report, year to date, the equities market as measured by the Nairobi Securities All-Share Index is up close to 15%. But again, as we always say as investment professionals, you need to have the stomach to take the ups and downs of the market, and hopefully you end up at the top by allocating some funds of your capital there. There is no single investment which can meet all your needs. We always highly advise for a diversified investment portfolio. Back to you, Hannah.
Thank you, Anthony, for a detailed answer to that question from you, Samuel. We have another question that has come in from Kiran, and this is a question to John. What's your view on the viability of the local infrastructure bonds? John.
Thank you. Again, very good question from Kiran. I think infrastructure bond, by the very definition, of course, are geared towards going to specific infrastructure projects. So these infrastructure projects could be building of dams, could be building of roads, could be building of all these public facilities. And I think in the past, of course, the government has issued a number of infrastructure bonds. I think now we are on the 23rd series of the infrastructure bonds that the central bank has been issuing. I think, of course, the returns have been quite good, and especially for premier investors like yourselves, given the tax incentives that comes with that, that has panned out quite well. Of course, I know you are probably also referring to some of the corporations that are obviously looking to issue specific infrastructure-related bonds. I think we have seen a number of players talk about issuing specific bonds to back, for example, affordable housing, or for example, specific road projects that are coming up going forward. I think as an investor, it's important, obviously, to evaluate those kind of opportunities. I think some of them are very good because in terms of just helping up, in terms of the broader country's infrastructure, that is one of the ways that obviously we'll need to fund that. So I think as an investor, the key important thing is obviously to do your homework for any of the issues that are coming into the market. I think as Anthony explained, obviously, when you're investing in these kind of infrastructure-related kind of structures, it's important to understand credit risk because, again, from a credit risk perspective, then you have a bit more comfort around whether the interest that has been promised or the principal will be repaid at the end of the period. But I think there are some decent opportunities that are coming up, as I said, within the affordable housing, within the road network or construction, some of these programs that we are seeing. So I think those are positions that obviously have to be evaluated on a case-by-case perspective to make sure that an investor is comfortable with the credit and also comfortable with the kind of returns that obviously coming with those kind of structures. I think in the interim, in the meantime, of course, the government offers, as I said, very good opportunity to be able to fund those kind of infrastructure through the normal bonds, through the normal bond program that is currently obviously keeps coming up and down, up. And I think you have already seen, for example, in the last 2-3 months, there was an infrastructure bond that was issued by government at a good yield. And I think those kind of opportunities are also important because government is guaranteeing that whatever it is that happens within these kind of projects, the government stands ready to be able to make good any interest or principal repayment at the end of the period. So long and short is to say that those opportunities are going to come. I think it's important to evaluate them from a credit perspective. Thank you.
Okay. Thank you, John, for that detailed assessment, and thank you, Kiran, for your question and engagement. We have another question coming in from Kevin. And this question is directed to you, Anthony. What is ABSA's view on current global inflation, specifically with a view on gold?
Thank you, Kevin. That's really a good question. I'm very sure Kevin must be following international markets because inflation now is a topical item in global markets or international markets. Previously, it had been ignored because the developed world has been running low inflationary periods for a long time. But if you listened to international business news for the last couple of weeks, inflation has become a concern. And global reserve banks or central banks have actually started showing strong signs of raising interest rates as a reaction to the inflation pressure. The only thing when we listen to the data and information and news coming from the international markets is that the inflation is to a large extent demand driven. That means, and demand driven inflation is not sticky. That will not stay for long. If the pressure from demand goes down, things improve. For example, in Europe, you must observe specifically in the UK, there's been a big a concern about the logistics industry and the ability for normal retailers to get supplies for their day-to-day shops. There is even a joke that you may not get your Christmas card or present because of logistical challenges, including lack of truck drivers, specifically in the UK. Now, the inflationary pressure coming from that is demand driven, and we think it's going to fade out. But the economies, reserve banks, central banks of this developed economy are actually coming very close to raising interest rates. We don't think that will have a local impact to a larger extent because the effect should be felt in the currency. But currently, our currency is not highly influenced by international inflationary pressures, but by two key items, which is the cost of energy, specifically fuel or petrol, and secondly, of course, plus electricity, but secondly, food-related items. So it's a good discussion, Kevin, which is happening out there in Europe, that now inflation is becoming a concern, but it will fizzle out if they sort out two key items: the logistics problem, which is in parts of Europe, and movement of goods and services, and secondly, the demand, the sudden demand of certain products and services after the economies were opened in a COVID recovery period. Thank you. I hope, Kevin, we've adequately responded to your question.
Thank you, Anthony, for that overview. And thank you, Kevin, for your engagement. We have one last comment from David. And this is a comment to both you, Anthony, and John. Thank you for the update. That is the truth on the current investment field. Thank you for that. Thank you for your engagement. Thank you for you logging in. Thank you for asking questions, for you being attentive throughout. We believe that this has been a helpful, delightful session for you, and we believe that you will be able to make better investment decisions as a result of this session, and over and above that we will be able to have added insight on what you already know on the investment markets. And on that, we seek to remind you that we have the session available on YouTube after this, and you will be able to have a look at it. So thank you for your time. Thank you for your engagement. Do have a good day. We'll carry on now to Onesimus.
Wow, what a session. Very insightful. I feel empowered. I hope you do as well. And just before I give my closing remarks, I'd like to remind our viewers that we shall be having a poll. We'll be running a poll at the end of this session. So we will gladly and appreciate your feedback. So thank you, everyone. Thank you to our speakers today. Thank you to the MC. But most importantly, thank you, our customers, our Premier customers, without whom this session will not have been possible. And we shall be doing more of such even in the coming year. And this is in line with the value proposition that we promise you, our Premier customers. So we shall be doing more of such, and we hope that you find them being a value add. In case you have any queries from today's session, you can always reach out to your relationship manager, and they'll gladly assist you. And we also want to thank you for your support throughout this year. And just in case we don't get to interact again before the new year, the Premier team would like to wish you happy holidays, and you keep safe and be blessed. Thank you, and have a good day.